Listen, here is the trick to making money on options. When you're about to execute a trade, stop, take a deep breath, wank it twice, and then do the exact opposite.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day. The S&P 500 virtually unchanged, pretty much flat, but we saw quite a bifurcated market. Technology, semiconductors, software, very green for some reason, led by Nvidia, AVGO, Salesforce. Apple was in the mix and infrastructure tech participated, all except Microsoft. Other than that, we saw green in energy, and then it was a very mixed bag across the board. Tesla was down on its delivery numbers. Google and Meta rallied yesterday. That's why we saw a little bit of a pullback, as well as a mixed bag, slightly flat to down in the financial space. All in all, guys, there was not much to say here. It was just a very mixed day with outliers, winners, losers. And the best performing sector was obviously energy. This is on the back of the move we saw yesterday. Yes, energy did pair some of their gains, still the best performing sector today, followed by technology and financials. And when you have like tech and financials in the green, that's really going to lift the market regardless of what every other sector does. We saw healthcare, industrials, comm services, real estate, materials. They were all red on the day, but staples and discretionary were the worst performing sectors here today, down 0.8 and 0.9%. And I think that has to do with the dock worker strikes. I've seen a lot of reports saying it's going to affect goods more specifically, so staples and discretionary are probably going to get a bit hammered in today's trade. And this mixed price action stemmed from a whole bunch of things today as well. We got a couple of Fed speakers. They had some very mixed views. Sentiment leading up to non-farms. The market is trying to digest what that's going to look like. But what did calm the nerves of the market today was a solid ADP employment report. Private sector employment increased by 143,000. The estimate was 123,000. Annual pay was up 4.7%, so a very strong ADP number. Now, the ADP employment report actually does a terrible job at forecasting the exact number for non-farms, but more often than not, it actually gives us the right direction. And we saw a beat right here, and we can probably expect more of the same in non-farms. Not a crystal ball, but we can assess probabilities from there. And that is why we actually saw outperformance in growth assets today, especially in the afternoon trade. We digested a lot of the market's news and yesterday's price action and the geopolitical tension in the morning. Then we sort of put a bottom in and sort of rallied into the afternoon, led by just risk assets, led by growth assets. Across the size and factor spectrum, small, mid, and large cap performed very well today, relatively speaking. Large cap core as well. And in fact, if you actually look at large cap value, they were virtually unchanged here on the day. The worst performing factors definitely was mid cap value, large cap value, and really it was a rotation into large cap growth, mid cap growth, and just anything that's slightly more higher quality than small caps. But much like the US was a mixed bag today, it was no different globally. We saw very mixed price action here in Asia, China leading the charge on the back of the stimulus, and we saw the entire Australasian region sort of divesting their money from their own indices and putting that money to work into China. We saw very mixed trade in Europe as well, and this led to very mixed trade here in the US, North America. Canada was slightly red, as well as South America. So a very mixed bag of data, a lot of political uncertainty, and that led to the global market doing what it did. On the back of the ADP report, we actually saw yields gain, volatility did subside, and bonds fell as a result. But the DXY, the dollar, did firmly gain, and it's approaching very key levels of resistance here at this 102 area. The US dollar found support at this $100 mark. It's made a bit of a rally since, and if it does go ahead and break above here, we could actually see upward momentum in the dollar. However, if we do find resistance at this area, I think we target the 100 area. I hate to be so binary. That's probably the price action we're going to see. So look for a break above or below the 102 area. Gold and silver were very very bifurcated as well. Gold was down 0.14% today, silver up 1.35%, crude was up 1.68% as well. And then looking at equity, slightly positive today. The S&P 500, like I said, virtually flat. The Nasdaq did gain 0.15%, the best performing index. The IWM was down 0.14%, but look at what's happening in the after hours. We're seeing a lot of upbeat momentum here in the IWM, the Qs, the SPY, the RSP as well, the equal weight, but particularly large cap stocks and small cap stocks. So it seems like mid caps, the equal weight sort of just getting left behind, but they have been the best performing index in the last quarter. Today, however, mid caps were pretty much flat and the SP 600 was down 0.43%. That's very weird considering what the IWM did. Maybe a dividend got paid in this particular index. I don't really know, but very weird to see that type of price action right there. All in all though, diving into the S&P 500, nothing has changed from the gamma flip zones yesterday. We saw continued support at the 56.75 area, and let's actually just have a look at market breadth before we continue. The advanced decline line doing very much the same thing as the S&P 500, trending lower from these all-time highs. That's very, very constructive, telling us that market breadth is following market price, and that is healthy nonetheless. So we saw a bit of a bounce back here at the 56.75. We saw yesterday and today, we saw buyers come in at the gamma flip zone. Very, very positive to see that. That means there's definitely conviction here, and that's more conviction in the bulls coming in and taking price higher more than it is the bears doubling down and taking us below this area. This is constructive price action for the bulls. And think about all the news we got in the last couple of days, and we're sort of still in positive gamma, finding support at a key level where we should find support. Very constructive if you ask me. Very similar situation to the Nasdaq 100. We'd find support right here, and this does mean we can target the 20,300 area, this high right here, and then all-time highs at this level. But we first have to build out some price action here and then actually make the move higher before we can actually start thinking about these levels. Because even though we are finding support right here, we get the bad NFP report, we slice right through these levels, and then it's 19,000 on the way down. And looking at the RTY, very similar situation to the S&P 500 and the Nasdaq 100, but instead of the lower levels of these wicks being where the gamma flip is, we've actually peaked into negative gamma. However, the bulls have still come in, supported price, and we're closing above the gamma flip zone here in the RTY. So very constructive, still in positive gamma, but we are seeing a little bit of weakness. And if we do get the close below the gamma flip, that can keep us in negative gamma, and then we could actually see a violent sell to the 2150 area. So I think the weakest out of all of these indices definitely is the RTY at the moment. But again, like I said yesterday, I remain constructively bullish as long as we're above this low right here. As long as we stay above this low right, I'm looking for 52-week highs, new all-time highs in the Russell. And then looking at the RSP, guys, if you are looking to buy pullbacks in the RSP, the 176 area is what you want to look to, as well as the 172 area. But if we do break below the 176 area, that could mean sell side to the 172. But again, I'm constructively bullish above this low right here, especially if we hold the 172 area to target new all-time highs in the RSP, which is this level right here. This chart looks really, really good, especially on a year-to-date basis. You know, you have textbook price action, a move higher, right? Consolidation, and then a move higher. And I think we're still in this move higher. And if we continue to move higher, right, and then we can consolidate at a higher base, I do think we see 200 sometime in 2025. But guys, equities look very, very good. Equities look strong. We're just seeing a bit of volatility in what is normally a historically volatile month in October. Do expect more of the same. And I do think that we do want to buy the dip in this market, because our end of year price target is 5,800, 5,900, 6,000. I think we can aim for those levels in the S&P 500, and any substantial dip we do get, you do want to be buyers if you haven't already positioned yourself here as well as here. Diving into seasonality, this is S&P 500 performance after a 6-month cycle where we have 1 down month, then 5 up months. That's the pattern. We hit this pattern at the end of September 2024, and these are the forward returns 1 month to 12 months and the max drawdown thereafter. And things are very, very bullish. You can see the average return 12 months later, 12.81%. 0.7%, 6 months later 6.2%, 3 months later 2.61%, and 1 month later 101 basis points in upside. Great hit rates across the board. 12 months later 27 wins, 2 losses. Very strong returns, and the drawdowns tend to be fairly minimal. However, we do have these outlier years where we can see double-digit drawdowns like we did in 2021 and 2023. So pretty much this data set is telling us that we can actually expect very linear returns. However, if we do get a massive double-digit drawdown, you do want to buy the dip, because this pattern right here tells us that we can expect higher highs in the 12 months following. And that's just the thing with bull markets. They are very resilient and often feature quiet strength. This right here is the quiet strength indicator, and it's just the sum of the number of days in the past week with a less than 1% swing on the S&P 500 and the number of days with new highs greater than new lows. And pretty much when this indicator is at the highs, it's pretty much saying we sort of get this stair step higher, right? And then a quick pullback lower, and then the stair step higher, making higher highs and a quick pullback lower. This is sort of what bull markets are built on, and it's very much like positive gamma and negative gamma that I talk about every single day. In positive gamma, you buy dips, sell rips, lean bullish. But in negative gamma, right, you don't lean bullish or bearish, you go with the trend. Remember why I always say in negative gamma, you sell into weakness, buy into strength, but you don't really have a bias to the downside. You sort of just take the trend where you go. And that's sort of what this indicator confirms. And that's almost what this data set confirms to a degree. You want to be bullish in a bull market, and you generally want to be long-term bullish on equities, because at the end of the day, equities tend to grow earnings. And when you have earnings growing and margins expanding like they are right now in the S&P 500, stocks tend to do very well, and they should do very well. We're finally getting 2026 earnings, and look at $311 per share. That's the earnings in the S&P 500. If we multiply that by a 20 PE ratio, the S&P 500 currently trades close to 22. Let's say a conservative 20 PE ratio, you're looking at a 6,100 price target on 2026 earnings. The market normally prices in 12 months in the future, so you're looking at 6,100 at the end of next year, maybe this time next year. That would be about 11% upside from the current levels. That's neither here or there. What we really want to look at is current earnings sitting at $241 per share for 2024. 2025 looking at $277 per share, and that's 15% growth next year. I do think these estimates do need to pull back. I think 260 is a more realistic target. Still very robust growth, and we're looking at double-digit growth in 2025 and 2026, with margins currently sitting at 12.9%. And for those of you that don't know, forward 12-month margins are sitting at about this level right here, at about the 13.3% mark. Very robust margins. Not quite what we saw during the everything bubble, during the COVID situation, 2020, 2021, but still very robust. And guys, here's the thing with analyst expectations. And oftentimes analysts don't nail the number on the T, but almost 85% of the time they do get the direction right. And right now they see earnings are growing and they see margins expanding, and stocks do very well in that type of environment. However, where does this earnings picture leave us with valuation? And right now things are looking rather pricey for the S&P 500 at 21.52 forward earnings. This is the PE ratio, and you could see that we are expensive on almost every single metric. We're above the 30-year average in the PE ratio, the CAPE ratio. We're below the 30-year average dividend yield, above the 30-year average price to book. We're trading at 16 times price to free cash flow and an earnings yield spread of negative 1.04%. Very interesting to see the S&P 500 overvalued on every single measure. I'd love to see what this looks like on an equal weight basis. Maybe that's something we'll tackle tomorrow. But how does all of this translate into returns over the next 5, 10 years and 1 year? JP Morgan split it out very quickly. This is forward PE and their subsequent 1-year returns based on current valuation metrics. And right now, looking here, we're looking at about a 1 to 2% return over the next year in the S&P 500 and a 5-year annualized return of about maybe 3 or 4% given the current valuation. So things look really, really stretched, and that's just a feature of bull markets. We see a lot of multiple expansion. We also see a lot of concentration at the top. The weight of the top 10 stocks in the S&P 500 now sits at a blistering 35.8%. It's actually down from its peak because we have seen a broadening out, and we've never seen concentration this high. Is it something to be worried about? I don't think so, because if you look at other markets, the US is not quite as concentrated as maybe stuff like Australia, Germany, Canada, many parts of Europe. You'd be surprised at how concentrated those markets are. These companies at the top are of extremely high quality and growing earnings the most, and therefore they deserve that premium. Nonetheless, there is concentration risk in the market right now, and that's also why we're seeing the broadening out in the market right now. The market recognizes that, and they're reacting accordingly. And diving into the macro, this is Atlanta Fed's GDP now. They track third quarter GDP in real time, and we saw a huge tick down from the 3.1% mark where growth was looking really frothy, really good in the context of the data and rate cuts, to where it's like, it's all right, it's not bad, it's not great, 2.5%. And that's sort of where we've been tracking for the last couple of months. We've been playing tug of war between the 2 and 3% mark. This is probably an indication as to where we're going to finish up. I think third quarter estimates, if you were to make a bet right now and say it's going to finish at 2.5%, I think that's probably a bet you're going to go out and win. The blue chip consensus, however, pretty much the big banks and investment houses see GDP coming in at slightly under 2%. So Atlanta Fed's tracking a little bit more dovish than the market, but that's generally always the case. And if history is anything to go by in the last 5 months, the GDP now has been far more accurate than the blue chip consensus. But growth comes in second place to the labor market. And yesterday we got the JOLT report, a very interesting report, very mixed report. We continue to see the softening of the job market. However, job openings increased ever so slightly. We beat expectation. This tally right here of 8.04 million job openings equates to 1.1 available jobs for every person looking for one. We also saw the quits rate, which measures voluntary separations as a percentage of total employment, at its lowest level since 2015, here at the 2.1% mark. So labor market participants continue to quit their job at a slower pace, and that's probably because they understand the dynamics in the market right now. The labor market has been cooling, it has been softening. It's a little bit harder to find work compared to the 2021-2020 peak, and as a result, people are just staying in their jobs. It does take a while to set in, and that's why we're seeing a slower quits rate. And part of the reason why employees are staying at their jobs is because employee compensation is looking very robust. In fact, if you look at the 1-year annualized figures, employee compensation as well as disposable income is actually outpacing PCE inflation, sitting at 6.3 and 5.4 annualized versus PCE inflation, which is 2.2% annualized as of August 2024. We see the 6-month annualized figures as well as the 3-month annualized figures roughly printing the same. And you can see this has actually been the case since 2020. Employee compensation and disposable income have outpaced PCE inflation handily, PCE increasing 18% since February 2020, employee compensation and disposable income increasing 28 and 31% respectively. And at the same time, we're also seeing real consumer spending by category up in every single measure year to date 2024. Absolutely nothing wrong with that, and the recent revisions in the personal savings rate has seen it being revised up to 5.2%. So this is telling us the consumers hanging in there, they have the money to do so. And guys, even the personal savings rate, even though this wasn't the rate we saw, before the 90s, if you actually go back to like the year 2000, this is probably at about the average in the last 20 years. And there's nothing wrong with being at the average considering everything the world has gone through in the last couple of years. Looking at data, we get more employment data tomorrow. We get initial jobless claims. We also get the services PMI, the ISM services number, and factory orders, then the non-farms figures. Now, initial jobless claims, BOFA's estimate is 224,000, but I want to see what that's going to look like with the dock worker strikes. I wonder if this number is going to tick up a lot bigger. I'd love to see the data that comes out on the back of that. And then ISM services, BOFA estimate 51 flat, the market consensus 51.5, and then factory orders at 0.2%. That's the market's consensus. Other than that, we'll tackle non-farms tomorrow in detail, but the average change we're looking for is between 140K and 150K. And guys, non-farms are huge because leading up into the election, the next two NFP prints are the main catalysts. This is S&P 500 daily implied moves now until the election. So the election is the big move. Then we have NFP on the 1st of November. That's going to be a big mover, as well as Friday's NFP. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.